Something significant happened in late May 2026, and most people missed it entirely. While American headlines celebrated a supposed easing of trade tensions, Beijing was quietly rewiring financial infrastructure, connecting its citizens to Wall Street. Simultaneously, Beijing unveiled a gold infrastructure plan, timed to launch this July. Two moves that together suggest something far more deliberate and coordinated. This appears to be a coordinated effort to pull Chinese money out of the U.S. financial system and build alternative pathways for global trade. On May 22, 2026, 8 Chinese regulatory bodies signed an official plan targeting illegal cross-border securities and funds market activity. The document mandates that mainland Chinese citizens holding US stocks through foreign platforms must sell positions and close accounts within roughly 2 years. No new money in, no new accounts. Every app and website connected to mainland clients is expected to go permanently dark by the deadline. Yuchu, Tiger Brokers, and Longbridge Securities were named specifically, with authorities signaling profits from mainland operations could be clawed back entirely. Markets responded immediately. Futu shares dropped roughly 28% in a single session. Tiger Brokers fell around 25%, billions in market value, evaporating within hours. The instinct is to read this as China tightening capital outflow controls. But that reading, while not wrong, is dangerously incomplete. Chinese households hold approximately $51 trillion in savings, the largest pool of private savings anywhere on Earth. And Beijing decided that arrangement no longer served their interests. When millions of savers use an app to buy Apple or Nvidia shares, they convert yuan into dollars, sending Chinese capital into American equity markets and U.S. government debt. Multiply individual accounts across a population of that size, and the result is a steady flow of money, propping up the S&P 500 and easing us borrowing costs. The timing is not accidental. The yuan has been strengthening, recently hitting its strongest level against the dollar since early 2023. Chinese industrial profits surged more than 18% year over year, and yuan-denominated bonds outperformed U.S. treasuries globally this year. Beijing can now credibly challenge conventional logic, not purely through force, but because domestic numbers are genuinely and measurably improving. The policy functions as both a stick and a carrot. Forced account closures paired with a domestic investment environment actually delivering real results. It is worth being honest about the limits here. The yuan accounts for roughly 3% of global payments, while the US dollar sits at 48 to 51%. Reserve currencies do not disappear quickly. The British pound lost its dominant position over decades, not years. Anyone claiming the dollar is finished by July is misleading you. But direction matters, even when you are not near the finish line. And Beijing has opened a second strategic front that tends to get less public attention. Large international transfers have long flowed through SWIFT, a network anchored in Western banking infrastructure that Washington demonstrated it could weaponize against rivals. When sanctions hit Russia and Iran, access was frozen with a few administrative keystrokes. Other countries noticed the obvious risk of depending on a network controlled by a potential adversary. So China built CIPS, the cross-border interbank payment system, launched in 2015, which processed around 350 billion yuan per Dalton Y in 2021. Then the global sanctions environment intensified, and the numbers shifted decisively. By early 2024, daily CIPS turnover had crossed 600 billion yuan. In March 2026, CIPS hit a single-day record of 1.22 trillion yuan, roughly $178 billion across approximately 42,000 transactions, with monthly averages jumping nearly 50%. By end of 2025, more than 1,700 financial institutions worldwide had connected to CIPS. Banks in the UAE, Turkey, and Central Asia joining out of practical self-interest, not ideology. The energy sector offers some of the most telling evidence. Saudi Arabia reportedly settled roughly 41% of its oil exports in yuan during one recent month. 2 major Saudi state banks joined CPs around the same period. The petrodollar arrangement that defined decades of global trade is visibly showing cracks. CIPS still relies on SWIFT messaging for over 80% of its transactions. It functions more as a parallel layer than a complete replacement. For now, China updated its CIPS rulebook for the first time in 8 years in February, with the explicit goal of expanding multi-currency handling and reducing SWIFT dependence incrementally. This brings us to the third element. Hong Kong is preparing to launch a central gold clearinghouse, operated by the Hong Kong Precious Metals Central Clearing Company. The system is designed to handle spot gold settlement, similar to what London has operated for decades, with the full launch targeted for July 2026. Clearinghouses live in the background, but are the reason large institutions and sovereign buyers can transact with confidence. And London held gold dominance, partly through this operational depth. Last summer, the Shanghai Gold Exchange opened its first offshore vault in Hong Kong, operated by Bank of China, the first physical expansion outside the mainland. Contracts there are denominated in yuan and settle in cash or physical gold, with storage fees waived initially to attract early institutional participants. Hong Kong has announced plans to expand its gold vault capacity from roughly 200 tons today to over 2,000 tons within 3 years, a tenfold increase in physical storage. Connect the threads: yuan-settled oil deals, a yuan gold market, and a clearinghouse built for scale, and a particular possibility comes into view. A country could sell oil to China, receive yuan, then use that yuan to acquire physical gold in a Hong Kong vault. The entire cycle completed without touching the dollar. Is this loop currently operating at full scale? No. But every component mentioned is real and documented with specific, recent official dates and verified regulatory actions. Central banks globally are reflecting this shift. The World Gold Council reports net purchases running hundreds of tons per quarter, with 2025 totals exceeding 800 tons. The appeal is straightforward. Gold cannot be frozen remotely. Russia's dollar reserves were effectively frozen with administrative action in 2022. Physical gold held in a domestic vault carries no equivalent counterparty risk. And in a world where financial systems become geopolitical instruments, that matters enormously. So does all of this genuinely threaten the United States' financial position? Honestly, the answer sits somewhere between catastrophe and business as usual. The dollar remains overwhelmingly dominant in global reserves. The yuan is not fully convertible. China still maintains strict capital controls over money moving in and out. The very order restricting foreign stock purchases is itself evidence of those walls being firmly in place. Tight capital controls and open reserve currency status are fundamentally incompatible. At the same time, the goal may not be replacing the dollar. It may simply be ensuring the dollar becomes one option among several rather than the only option. That is a more achievable objective, and it matters. When sanctioned parties have viable exits, the leverage that dollar dominance provides begins to erode at the edges. U.S. borrowing costs may eventually reflect a smaller share of global demand for dollar assets as alternatives gain genuine institutional credibility worldwide. The shift is gradual and hard to identify at any single moment, which is precisely what makes it difficult for policymakers to recognize and respond to effectively. Underneath the policy moves sits a calculation that $51 trillion domestic savings pool is being treated as a strategic resource to be directed rather than allowed to flow freely. Keep capital inside, channel it toward higher-yielding local bonds, support a strengthening yuan, and use it to build payment and gold infrastructure the world eventually engages with. Each component of the strategy reinforces the others, raising a genuine question: does openness become a structural vulnerability in this particular financial competition? There is no clean answer, rather than predictions. Here are things worth watching as this strategic realignment continues to develop over coming months. Monitor CIPS transaction volumes. If records keep falling and SWIFT-reliant proportions shrink, that is financial independence being built in real time, measurably and verifiably. After July, watch what actually happens with the Hong Kong Gold Clearinghouse, whether it attracts real institutional volume or functions mainly as infrastructure awaiting scale. Track the yuan share in global payments. It sits at 3% today. Movement toward 5% or 7% would signal that the slow shift is meaningfully and consistently accelerating. Watch whether other major economies begin adopting similar approaches to guiding domestic savings strategically. This could become a broader global template for financial sovereignty. Whatever you take from all of this, avoid panic. Claims that the dollar collapses this summer or that savings are immediately at risk are not grounded in what is actually happening. What is happening is slower, more deliberate, and ultimately more consequential than a crash narrative. It is the construction of alternatives, not the arrival of a crisis. It is an off-ramp from dollar dependence, transforming a monopoly into a majority position. And a majority is not the same as total dominance in long-term geopolitical leverage. One thing is easy to overlook. Beijing is absorbing real costs to pursue this strategy. Deflation pressures, property recovery challenges, and friction with global trading partners. A stronger yuan raises costs for Chinese exporters at a time when manufacturing needs every advantage. Walls keeping money inside can also discourage outside confidence from flowing in. This is not a frictionless master plan. It is a significant strategic bet with genuine and acknowledged downsides, and Beijing may not get every part of it right. But the willingness to absorb those costs is itself deeply informative. It tells you how seriously Chinese leadership views financial separation from the U.S. system as a priority. They are accepting short-term economic pain because they regard it as essential insulation against long-term vulnerability. A generational calculation about structural financial independence. When your largest economic competitor decides getting out from under your financial umbrella is worth struggling for, that is a development worth understanding carefully and calmly. A question worth sitting with: if $51 trillion in savings stops supporting your borrowing, if alternative payment systems mature, at what point does this stop being their story and become yours? Stories that illuminate large structural shifts before they dominate the news cycle are what you come here for. Subscribing helps ensure you keep seeing them.